Why do so many new Big Law partners feel broke in the first couple years after the transition? That's even after getting a raise. Short answer, taxes. I recently did an analysis for a client who had just made the transition, and we found that after all said and done, she would take home 15% less income than she was as a senior associate. So in this video, I'm going to break down the specific tax changes that happen when you transition from associate to partner and the cash flow challenges that can creep up from it. Hey guys, I'm Joel, your Big Law Money Guide. I'm married to a former Big Law attorney, and I've educated hundreds of attorneys on the topic of personal finance. So follow along if you want to make smarter financial decisions. By the way, this is the third of a series of 5 videos on the transition to partner in Big Law. So if you want to watch the other videos, check them out in the description below. So what are the biggest tax changes that create these cash flow problems? First, there is a fundamental shift on how you get taxed when you transition from associate to partner. That's because you're going from an employee to a business owner. As an employee, you receive a wage and taxes are withheld from your paychecks and sent to the IRS on your behalf. And you get that income reported on Form W-2. At the end of the year, you hand that to your accountant, and if you overpaid your withholdings, then you get a tax refund. If you've underpaid, then you owe taxes. Simple enough. But as a partner, you are now considered self-employed. I know they may not feel that way because you're still part of a large firm with hundreds of attorneys and employees and all that, but you're a business owner now, just like if you owned a coffee shop around the corner from your office. And that means that taxes are no longer withheld from your paycheck. So it's your responsibility to remit those taxes to the IRS each quarter. And those are called quarterly estimated tax payments. And all of that income is reported to you on Form K-1 instead of Form W-2. Now you might be thinking, okay, so I just have to save for taxes each quarter? How hard can that be? Well, here's where it gets tricky, where a lot of new partners get in trouble. The IRS requires you to pay taxes as you earn income throughout the year, and these payments are due each quarter. And our lovely government decided to make things even more interesting because their quarters, the IRS quarters, don't align with regular calendar quarters. Let me show you what I mean. As you can see, the calendar quarters don't align with the IRS tax quarters. The first quarter is January through March, with the first payment due by April 15th. Q2 is actually April and May only, and the payment is due by June 15th. Q3 is June through August, and the payment is due by September 15th. Well, lastly, Q4 is September through December, so 4 months, with your payments due by January 15th of the following year. So notice that Q2 is actually only 2 months, and Q4 is 4 months. So this can create cash flow issues from your partners. Another tricky part is that these payments are estimates. So they're yours and your accountant's best guess on how much income you're going to make for that year and how much taxes you should owe. And if you guess poorly, you could be subject to underpayment penalties. So it's not like you can just wait till the end of the year and figure out how much income you made for that year and just cut a large check to the IRS. If you do that, you're going to get hit with penalties. That's why it's so important to work with a competent CPA who understands partnership income. You may have to pay a little bit for their services, but trust me, it's worth it. Otherwise, you may end up paying that or more in tax penalties. But the quarterly payments are just one piece of the puzzle. There's another tax change that usually catches new partners off guard. When you're an associate in Big Law, you pay a Social Security and Medicare tax. But did you know that you actually split the bill with your firm? You pay half and they pay half. As a partner, you're both the employee and the employer, so you pay both sides of the tax, which is 15.3%. This is called the self-employment tax. But the good news is for 2026, only the first $184,500 is subject to the Social Security tax, which is 12.4% of the total 15.3%. So you can roughly expect to pay around $23,000 for the Social Security tax. It's a big misconception that your entire income is subject to this self-employment tax. Only the Medicare portion, which is 2.9%, is subject to the full income. Also, half of that self-employment tax is actually deductible on your personal tax return, so you get some help there as well. Bottom line is the self-employment tax does increase your tax liability, and it's in part why a lot of new Big Law partners feel like they're broke in the first couple years after the transition. Here's another tax change that surprises new partners in Big Law. You now have to pay your share of the firm's profits in all of the states where it operates. So even if you live in a state with no income tax like Texas or Florida, you're still going to have to pay your share of the tax liability in the different states where the firm operates. But typically, most firms will allow their partners to opt in or what we call a composite return. So the firm will withhold a portion of your draw or your quarterly distributions and send the payments to different states on your behalf so that you don't have to file an individual return with each of those states. Now, keep in mind that New York does require you to file an individual return. So that will add to the cost and the complexity of your tax return. All right. So to summarize so far, we have quarterly estimated tax payments, the self-employment tax, and multi-state tax filings. But here's a real challenge that ties all of this together. The biggest adjustment when you transition from associate to partner in Big Law is managing your cash flow. As an associate, whatever hits your bank account is yours to keep because the taxes were already withheld and sent to the IRS. But as a partner, a big portion of what you get in your bank account actually belongs to the IRS for your quarterly estimated tax payments. On top of that, the mismatch between calendar quarters and the IRS quarters can really create some cash flow crunches. So I'll give you an example. Let's say a new partner's tax liability is projected to be $100,000. So their account might recommend that they make 4 equal payments of $25,000 to the IRS each quarter. But if you remember, the second quarter is only 2 months. So they would owe 25% of their tax liability in Q2, but only receive 2 months worth of income. So 15% worth of income. So you can see the mismatch and how that could create some cash flow issues. So compound that by the fact that most of the partner's income is received in Q4. Think about it. You have 4 months of draws, your quarterly distribution for Q4, which is usually much larger in Big Law because of the end of the year, the deals closing and all that. And then you may have your bonus. So you may get over 50% of your income only in Q4. But by then you've made 3/4 of your payments for your tax liability. So again, that can create some cash flow crunches in the first 3 quarters of the year. If you want to learn more about the transition from associate to partner in Big Law and the overall impact on your personal finances, you can sign up for my free partnership transition email course by signing up in the link in my bio. So what happens if you fall behind on these payments? Well, let me show you. Falling behind on quarterly estimated tax payments can trigger IRS penalties. And when you're earning multiple 6 figures like Big Law partners, those penalties can climb into thousands of dollars each year. As I mentioned before, Big Law income is very lumpy, often backloaded at the end of the year in Q4. But the IRS actually assumes that you earn your income equally throughout the year, and you must pay as you go and make your 4 quarterly estimated payments by the deadline. So that's April 15th, June 15th, September 15th, and January 15th. And if you miss those targets, meaning you haven't paid enough by those deadlines, then you're hit with underpayment penalties that start accruing interest. But thankfully, there are 2 things you can do to help protect yourself against underpayment penalties. The first one is a safe harbor provision, which states that you have to pay 110% of your previous year's tax liability to avoid any underpayments. So for example, if last year your tax liability was $100,000, if you make at least $110,000 worth of payments, so 110% of last year, then you shouldn't be subject to underpayment penalties. But as I mentioned, the IRS assumes that you earn your income equally throughout the year. So you can just make a $110,000 payment before January 15th and call it a day. The second is the annualized installment method. So as I mentioned, the IRS assumes that you earn your income equally throughout the year. So you can just wake up on January 1st and make your entire safe harbor payment for the whole year. Because you haven't paid throughout the year, you would be hit with some penalties. So because of that, they allow you to file the annualized installment method on your tax return to smooth out your income throughout the year if you receive most of it in the 4th quarter. So talk to your accountant about that to make sure that they help you file that on your return. So while these strategies help you avoid underpayment penalties, they won't solve your cash flow problem. So what's the best way to stay ahead? I recommend 2 things to my clients. Number 1, hire a competent tax accountant that specializes in working with Big Law partners that are familiar with multi-state tax filings and all the other intricacies of being a partner in Big Law. Now, you can expect to pay between $2,500 and $5,000 for your return, depending on where you are and the complexity of your return. But Again, trust me, it's well worth paying those dollars to accurately file your return. If you want a list of vetted accounts for Bigelow Partners, just hit me up on LinkedIn or on Instagram and I'm happy to send it to you. Number 2, open a high yield savings account dedicated for taxes. So what you're going to want to do is every time you get paid, whether it's a draw, quarterly distribution, or a bonus, is set aside a set percentage that you predetermine with your CPA and transfer directly to that account automatically. So let's say you established that you want to transfer 40% of every time you get paid. And let's say you get a $20,000 draw where you're going to send $8,000 to your high yield savings account. And then when the quarterly tax payment is due, you just pay straight out of that account. So it's kind of out of sight, out of mind. So this ensures that you don't spend money that is actually not yours. One thing I usually recommend to new partners is that they pre-fund this account with at least 1 quarter's worth of taxes so that they're always ahead and never, draining that account to zero every quarter. One way to do this is to use your last associate bonus to fund this account. So as you can see, the minute that you make partner, your tax situation gets a lot more complex. You're managing quarterly estimated tax payments, the new self-employment tax, multi-state tax filings, all that while trying to adjust to your new role at the firm. This is why surrounding yourself with a good team, so this is a knowledgeable CPA, and shameless plug here, but a financial advisor who understands big law attorneys makes such a difference. Your CPA handles the technical tax side, and your financial advisor integrates your expenses, your savings, and your goals with your quarterly tax payment strategy. So this ensures that you're always ahead and you're always in control of your cash flow. In the next video of the series, I'm covering the benefits changes that happen when you make partner, including retirement plans and health benefits that are no longer subsidized. You can click the video on the screen to watch now, or you can go to the description below. Thanks for watching.